Good evening, students. Welcome to session 2 of CL2 paper, June 2023, right? June 2023 CL2 paper discussion. Once again, let me thank CS Sri Lanka for organizing this session for the benefit of students community of CS Sri Lanka, especially targeting the upcoming examination for CL2 students, right? So in the first session, what we did was actually we discussed first three questions, right? In this paper, first three questions were discussed. If someone missed those areas, that means the first session, I believe that CS Sri Lanka will definitely upload the recording and where you can watch the recorded video, right? So here, in terms of question number 4, which is actually an area that is repeatedly tested in the examination. So, which is from the professional ethics, okay, ethical responsibilities of an accountant. So, once you become a chartered accountant, as well as when you are a student, you need to adhere to certain ethics. So, this particular question is out of that area. As usual, before reading the question, look at the requirement, then when you read the question, you can plan the answer, right? So the question number 4 wants us to explain the ethical principles, right? Ethical principles that is impaired in each of the above scenario. Now you have been given 5 scenarios. What you need to explain is what are the ethical principles that have been breached in each of the scenario. Before moving to the what you call scenario straight away. So this is actually the PowerPoint presentation which I have already shared with you, tutorial number 1. So where, as mentioned, we discussed the first 3 questions. So today the discussion would be for question number 4. So before moving to the scenarios, right? So you should be aware that in your syllabus, so there are 5 fundamental ethical principles where an accountant has to adhere to, right? So actually those scenarios, what is then the question is tested from these five fundamental ethical principles, right? Which principle have been breached in each scenario, right? So in summary, so these 5 are integrity, objectivity, professional competency and due care, then confidentiality and professional behavior, right? So we need to discuss each of these things in detail and to explain that which fundamental ethical principles have been breached in each scenario, right? So let's now look at the first scenario. With the scenarios, let's understand what these concepts are, right? What these 5 fundamental principles are. So you have been given the following scenarios in relation to the violation of Code of Ethics 2020, that is applicable framework. Assume that each violation has been committed by members of Sri Lanka. So members have violated ethics in each scenario. You need to understand which principle have been violated. Okay, right. First scenario, where the fair value of land and building of Clear PLC as at 31st March 2023 was determined based on the director's valuation. So the fair value was determined based on the what? Director's valuation. Fair value of land and building was determined based on the director's valuation. So the year end is 31st March 2023. The accountant of the company disclosed in the financial statements that valuation of land and building was carried out by a professionally qualified valuer. So what the accountant has done, what he has disclosed, he has mentioned that valuation of land and building was done by a professionally qualified valuer. So even though it is director's valuation, he has mentioned that it is done by a third party independent professionally qualified valuer, knowing that that is wrong. So what do you say? Which fundamental ethical principles have been breached? Any guesses before I tell my answer to you? Which one is breached out of the 5 fundamental ethical principles that I have mentioned over here? The first one is breached, right? That is integrity. So what do you mean by integrity? Integrity means you should be straightforward and honest. Straightforward and honest in your professional and business relationships. Now, if you do manipulations, if you cook the book, if you mislead people by providing wrong information, you are breaching the first out of the 5 fundamental ethical principles of integrity, right? So if I go there, so the integrity means mainly you should be honest and you should be straightforward. So the accountant has disclosed wrong or misleading piece of information. He said that the land and building was fair valued by a professionally qualified valuer, but actually it was done by the directors. So basically, integrity means if you mislead, if you mislead anything, knowingly that you provide inaccurate information, or sometimes you conceal certain information. So necessary disclosures, you are not making the necessary disclosures, knowing that that is a requirement. So all these things are what? All these things affects integrity. I hope you understood about it, right? So uh, for the first scenario, the answer is integrity. Then we have to briefly explain how the integrity is violated as what is depicted in this slide. Okay, right. So let's look at the second scenario. Second scenario is Tile PLC pays an annual bonus to the staff in its finance division based on the completion of monthly accounts for each month on or before 10th of the succeeding month. Okay, there's a performance target, right? So the annual bonus of the finance division staff is paid based on the what? Completion of monthly accounts. Complete the monthly account before the end of the succeeding month. Okay, if you are working in a accounts department, finance division of a company, month-end process is one of the important process. You have to close the financial statements of the previous month and you have to show that performance and position of that particular month. Now, this company, you have to do it before the 10th of the following month. Therefore, finance director has advised his staff to record the here notional entries, record notional entries for obsolete and damaged inventory provisions at the end of each month and record the correct amount in the next. What he has made, what he has communicated to staff here, our bonus is depending on what? Completion of the accounts by 10th of the following month. So it is difficult for us to ascertain, or you have to work really, really hard. You have to stay, long hours in case if you need to get the correct amount of, obsolete and damaged inventory. Because of that, you close the accounts by keeping a provision. By making a provision, you close the accounts. Then maybe after 10th of the following month, you relook at it and adjust the provision figure. So the correct amount maybe is, finalizing the figure maybe on 20th of the next month. So where what he does is he adjusts the provision value. Now, is it who has communicated this? Head of the division. Who is the head of the division? Finance director. Now, what do you say? Is he adhering into code of ethics or not? He's not adhering into code of ethics. Now, which one out of these 5 fundamental ethical principles have been breached by the finance director? In this case, it is what? Objectivity. What does that mean by objectivity? What is the meaning of the word objectivity? Objectivity means when you make the professional and business judgments, right? When you make the professional and business judgment, you should be unbiased and you should not have any conflict of interest, as well as you should not have any undue influence. So in this case, actually, he is biased. Why he is biased? Because he knows that if there's a delay, the staff in the finance department as well as his bonus is going to be affected. So you do something, right? You are biased here to obtain a personal gain. What is the personal gain? Get your bonus. So the objectivity is all about the intention. Doing a mistake means what is getting affected? Integrity. Okay, doing a mistake means integrity, but you do that by expecting something for your personal gain. Your judgment is affected to get a personal gain. What is getting affected? Objective. So basically, in the second scenario, which one out of the five fundamental principles have been affected? Objective. So the objectivity means you should not allow any biasness, right? When you make the judgment decisions, as the delay in monthly accounts will affect the bonus entitlement of the finance division employees, including himself. The finance director made a biased decision to record notional amount as inventory provision in the monthly accounts. Simple and straightforward. Understood? Right. So that is the current scenario. Let's go to the third. Let's go to the third one. Third scenario is engagement partner of My Life Insurance Private Limited. You are the engagement partner of this company, My Life Insurance Private Limited. My Life Insurance Private Limited is your client. You are the audit partner. Has no previous experience relating to insurance. So the insurance is a specialized area, right? Specialized sector. Now you are acting as the audit partner of an insurance company where, as the audit partner, you don't have any previous experience in the insurance industry. And he has not updated his knowledge on insurance standard. Yes, you don't have experience. And also, if you don't have any experience, what you can do at least to update your knowledge, but he has not done that as well. So there's a specific standard for the accounting of insurance contracts. He has not, got updated about that aspect as well. And the insurance industry, he doesn't have experience, as well as he has not got his knowledge updated in terms of the insurance standard as well as the insurance industry. This one is a very simple one. Everyone can say which one out of the five fundamental ethical principles have been breached. Very simple. Professional competency and the due care, right? So here, professional competency and the due care means you should have knowledge and skills to provide competent service to your employer or to your client, right? You should have the sufficient knowledge and skills to provide professional and competent service for your employer if you are working in a company, or to your client if you are acting as an audit partner or working in an audit firm, right? And also professional competency, due care. Due care means what? In this particular area, what is mainly tested is the professional competency, but for your knowledge, what is due care? You need to act diligently. You should not do reckless mistakes, right? So now in this situation, it's straightforward, as I mentioned, as a result of not maintaining the professional knowledge and skills in relation to the insurance industry at the level required to conduct the audit as an insurance company. Now in this case, audit partner doesn't have the knowledge, previous experience, he doesn't know the insurance standard, so that he is not going to provide a professional and competent service to the company, that is to My Life Insurance Private Limited as well as its shareholders, because company shareholders are trusting the auditors, so they expect auditor to give an opinion about the fairness, true and fairness of the financial statements. Now the audit partner doesn't have the competency, mean he's just giving an opinion where shareholders believe that what he says, he's like giving a opinion with a by doing so, understanding the industry by doing the audit in diligent manner. So he has the knowledge and the skills to provide this opinion. So that is the expectation of the company and the shareholders, but it is actually not. So the My Life Insurance Private Limited and the shareholders did not receive competent professional service by the audit partner. I hope you understood that aspect as well. So good that a lot of students are giving the correct answers to the questions. That's really good. Okay. Right. Moving on to the scenario number 4. Audit manager. Again, audit manager of Live PLC. So the company again, audit manager. So who is the client? Live PLC. Met a best friend of his who is a shareholder of Live PLC. Now there's a best friend of the audit manager is also a shareholder of your client. You understand the relationship, right? So there's a best friend. Say some friend is there, he's a shareholder of Live PLC, and you are the audit manager of Live PLC, right? And you met him at a wedding, a private function, right? Knowing that the friend has material investment in Live PLC. Now, as the audit manager, you know that your friend is having a material investment in shares of Live PLC. He discussed the subsidiary disposal plans of the company observed from board minutes, which is yet to be informed to the shareholders. There are some unpublished price-sensitive information. So this company like PLC is going to dispose one of its subsidiaries. There's a plan, and that plan is, how the audit manager got to know is because audit manager read the board minutes and it was mentioned in the board minutes. Now, what audit manager has done was he went for a wedding, right? So there he met his friend, and knowing that that friend is having shares in Live PLC, he revealed about this subsidiary disposal plan to the friend who is having shares in the company. Now, this is unpublished price-sensitive information. So what is the fundamental ethical principles that you're talking about here? Again, very simple, confidentiality, right? So what does that mean by confidentiality? So you should not reveal information that you acquire in your professional and the business relationships without having the proper and specific authority, right? So here, audit manager doesn't have any authority to disclose this information, but he has done that, right? So what is breached? What fundamental ethical principle is breached? Confidential, right? Sometimes you might need to disclose because of a legal. So there may be a court order for you to disclose something. At that time, you can do it, right? If you have a legal right, if you have a professional right, you can do it. Unless otherwise that, so whatever the information that you acquire in your professional and business dealings, you should not reveal without proper and specific authority, right? So what is getting breached is, as I mentioned, confidentiality, right? So by discussing information gathered from board minute as well, which have not yet been disclosed to the public. So which have not yet been disclosed to the public. Audit manager has failed to maintain the confidentiality of the client information, right? So this is the answer to that particular scenario number 4. Right, moving on. Fifth and the final scenario. What is that? A tax consultant applied the wrong tax rate in the income tax liability computation of a listed company. So here at this time, you are a tax consultant. So the member, chartered accountant is a tax consultant. Here he has applied the wrong tax rate in the income tax computation of a listed company. Instead of, let's say, 30%, you have applied, let's say, 24%, some other rate. Therefore, company had to pay huge penalty. Inland Revenue has filed the case, so the Inland Revenue has informed that, so the company had to pay a huge penalty because when you have unpaid taxes are in arrears. Not only you need to pay the tax amount, but also the penalty imposed by the Inland Revenue Department. So the company had to pay this penalty, and it sued the tax consultant for filing the wrong tax return. Now, what company has done was, okay, company had to pay penalties. No, what company has done was, company suing the tax consultant. So company filed the case against the tax consultant. Here we have taken you a service. We have not given it proper manner. So because of that, not only we have to pay you your professional fees, but also we have to pay penalties, because when you are taking the service of the tax consultants, that is very expensive, right? So the company had paid them. Not only that, now company has to pay penalties because of the mistake done by the tax consultant, because tax consultant has taken a wrong tax for filing the wrong tax return. The tax consultant behaved in harsh manner when the company requested him to admit his oversight in the court. So what he has done was, he came to the court and might have been, so what he has done is, he has acted in a harsh manner to the client, right? So now in this situation, what do you say? Which fundamental ethical principles have been breached? Which one? Last one, right? So what is it? Professional behavior. So what do you mean by professional behavior? So the members need to adhere to the laws and regulations. Now, in this case, what is the law and the regulation? Inland Revenue Act. So the member or the tax consultant has not adhered into the relevant income tax law. So he has applied a wrong tax rate. And also, professional behavior includes two things actually. One is, you need to adhere into the rules and the regulations, or the laws and the regulations, and also you should not disrepute the profession. Now here, what tax consultant has done was, he disreputed the profession, because why? He acted in harsh manner. Being harsh to the client is not the professional behavior. By doing that, you discredit the profession. So that's how this professional behavior is getting affected in this scenario. So the professional behavior means, avoid any actions that discredit the profession. Avoid any action that discredit the profession, and also comply with the relevant laws and regulations. Tax consultant has failed to comply with the relevant laws and regulations in relation to the provisions of the Inland Revenue Act. He has not followed the Inland Revenue Act, and also being harsh to the client, he is bringing disrepute to the profession as well. Right? So 5 scenarios are given. So in each of these 5 scenarios, one of the 5 fundamental ethical principles have been breached. Actually, examiner is helping you, right? So he has given the scenario in the order that you study. So this is the order that you study, right? Integrity, objectivity, professional competency and due care, confidentiality, and the professional behavior. And each scenario, one of these 5 fundamental principles are getting breached. So that examiner is not your enemy, right? So he's helping you, he's supporting you. So 5 fundamental principles without even change in the pages, he has given in order, right? So then in the examination, in addition to this, when we talk about this topic, professional ethics, right? So we know now what are the fundamental ethical principles that the professional accountants are need to be adhered into. That is these 5. Then in addition to that, in this area, you also should understand what are the threats that the professional accountants are facing, where they are, because of these threats, they are unable to adhere into these 5 fundamental ethical principles. What are the threats that would make it difficult for the professional accountant to adhere to these 5 fundamental principles? It is not necessarily in this question, but just for your knowledge, what are these 5 threats? Can anybody tell me? Self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. So because of these threats, so it creates, kind of a difficulty for the accountants to adhere to these 5 fundamental ethical principles. Then when these threats are identified, what accountants has to do? When accountants see that, okay, these threats are there, these 5 threats: self-interest, self-review, advocacy, intimidation, and familiarity threat. So then what accountant has to do is, what accountant has to do is, accountant has to put the safeguards. So there are safeguards which are created. There are different types of safeguards which are created to reduce or to eliminate these threats, right? So you need to apply the safeguards. So there are different types of safeguards. Yet again, not a part to this particular question, but for your knowledge. So there are 3 types of safeguards which are available for the professional accountants. What are they? Number 1, safeguards created through the profession, regulation, and the legislation. Then the safeguards created within your organization, and also the safeguards created through your learning, experience, training. And also after become a member, there's something called continuous professional development route that you need to follow. Through these also safeguards are created. So what I'm telling is, in this question, the question focus was only on the 5 fundamental ethical principles. But these are past paper. So when you are facing for the examination, in addition to these 5 fundamental ethical principles, please be aware about the threats, 5 threats, as well as what are the safeguards exist to eliminate or to reduce these 5 types of threats. So that's an additional point. Just I wanted to mention you in addition to the answer to this question. Right. Okay. So with that, we are done with question number 4. Right, we are done with question number 4. Then what we can do is we can move to question number 5. Okay, we can move to question number 5. So question number 5, again, as usual, it's a question from financial statement and analysis. So where in each and every paper, CL2 paper, you definitely find a question from financial statement analysis, right? Right. So now, if you look at the requirement of the question, before reading the question, if you look at the requirement of the question, calculate the following ratios for the financial year 2023 and financial year 2022 based on the available information. You are required to do certain calculations. Calculate the ratios for the year 2023 and 2022. That is, 2023 is the current year, 2022 is the last year, right? And also you have been given the current year, that is 2023 industry figures as well. So here what you compute is current year and the last year. 3 ratios are to be computed. One is gross profit margin, second one is inventory holding period, third one is debtors collection period. You need to calculate these ratios. Thereafter, right, so first of all, let's calculate the ratios before moving to the part B. Now, what information that you have been given here? PMP Supermarket Private Limited, which is called as PMP, is an island-wide supermarket chain. Island-wide supermarket chain. Following information is available for the company and the industry, right? So you have been given following information for the company and the industry. So what ratios are being given? Debt to equity ratio was given, that is debt divided by equity. Figures are given, right? I'm going to read the figures. Then total assets to equity, right? Total assets divided by the equity. Yet again, the figures are given. Interest cover, right? So all of you know what is interest cover is, right? Now, if you look at the first two, that is very simple and straightforward. What you do is, in the first ratio, you take debt divided by equity, right? Then the second ratio, asset to equity. That is not a common ratio. Asset divided by, in this way. First one is debt divided by equity. And the second one is total asset to equity. Assets divided by, actually, that is not a common type of a ratio, right? Debt to equity, we all know, right? Here. So the asset divided by equity. asset divided by equity. So that is not common, but it measures the same thing, right? Because now if I ask you if I ask you a question now, debt to equity having a higher ratio means what? Your gearing is high. Now, if you look at numbers last year, debt to equity ratio 0.84, this year 0.5. So the gearing has come down. Gearing has come down means what? Financial risk has come down. What do you mean by financial risk? What do you mean by financial risk? When you have more and more debt in your capital structure, your fixed commitments are high, right? What do you mean by fixed commitments? When you have debt, you must pay interest. Interest is a fixed commitment. So you have higher amount of fixed commitments means what? Your risk is high. But on the other hand, let's say if your capital structure consists equity, equity means what? Shareholders funds. You pay them dividends or whatever only once the company makes profits. It's not a fixed commitment. So that's why we say that having debt increase the gearing as well as it increases the what? Financial risk, fixed commitment to the company. Right? So then what about the total asset to equity? You take assets as the numerator, divide that by equity. So that also shows that gearing has come down. Why? Because now the ratio 1.84 has come down to 1.50. So what does that mean that this ratio has come down? Your denominator has gone up, right? Okay, your equity value is going up means what? This ratio is coming down. So your equity value is going up means what? Your gearing is getting reduced. So both these ratios, debt to equity and asset to equity, shows that the gearing position of the company has come down. And also the gearing position of the company is significantly below than the industry average. So the industry figures are high. Actually, I'm now answering part B. Part B is what? Analyze the company's performance in financial year 2023 against the industry and the prior period. We analyze the company's performance, that is current year, against the prior year as well as the industry. First thing we analyzed is about what? Gearing. What about the gearing? Right? So the gearing level has come down comparing with the last year. It is evident by both debt to equity and the total asset to equity ratios. And also you can say that comparing with the industry, this particular company's gearing is low. So which means this company's financial risk is low. Its commitments are low. Right? So because of that, what has happened? Interest cover ratio has gone up. How to calculate interest cover ratio? What do we mean by interest cover ratio? EBIT divided by interest. So how many times you can pay your interest by using the profit before interest and tax? By your operating profit, how many times that you can pay your interest? So always good to have a higher interest coverage. Now, if you look at the last year, it was only 1.8 times. So you can pay your interest 1.8 times from your operating profit. This year, that has gone up. You can pay your interest 2.27 times, right? By using your operating profit, right? So going up, interest coverage going up means what? It's a good thing. So why it has gone up is because why earlier we looked at our gearing is getting reduced. Gearing is getting reduced means what? Obviously, our interest expenditure is coming down. Gearing is getting reduced means debt is getting reduced. Equity is going up. Your interest expense is going down. So once your interest expense is going down, obviously interest cover ratio goes up. So that's what it has happened last year, this year. And also, it is better than the industry average because earlier we looked at our company's gearing is less than the industry. So as the gearing is less than the industry, interest cover is better than the industry as well. So we actually talk about the gearing. So we have already answered to Roman number 1 of part B. I have to part A, right? But by looking at the ratios, actually, I have answered to that gearing. So let's look at the answer there before moving part A, right? What I have explained is there you can find out. You see, if you look at this, why it says both debt to equity ratio and total asset to equity ratio have decreased during the financial year 2023 compared to financial year 2022. Correct? Suggesting that company has become less levered. Less levered means less gearing. Both the ratios are significantly lower than the industry average, suggesting that company is less levered to the industry average. Consequently, interest cover in financial year 2023 has increased to 2.27 times from 1.8 times. This is significantly better than the industry average. Exactly what I have mentioned is there in the answer, isn't it? Less geared, less leverage, interest cover is improved comparing with the last year as well as the industry average. Right. Okay. So right now, let's look at the rest of it. Then you have been given return on capital employed numbers as well, right? You have been given the asset turnover figures as well, right? So that is actually coming about the Roman number 2 of the part B, right? Roman number 2 of the part B, but let's complete part A. Now you have been given then certain numbers: revenue, cost of sales, average inventory, and average receivable figures for the year 2023 and year 2022. You have been given the revenue, cost of sales, average inventory, and average receivable. Then you are asked to calculate very simple ratios, right? Gross profit margin. How to calculate the gross profit margin? So these are easy marks, right? So that's why we say that CL2 is an examination where it is very difficult for you to fail, right? Very difficult to fail. Because these are easy marks. Unless otherwise you make an effort by yourself to fail, you can't fail here. Right? These 6 marks are peanuts. Why? Everyone knows that how to calculate the gross profit. How to calculate the gross profit? The difference between the revenue and cost of sales. Revenue 600, cost of sales how much? 500 million. So what is the gap between these two? 100. 100 is the gross profit. To calculate the gross profit margin, divide that by revenue figure. What is the revenue figure? 600. So if you look at the answer here, 600 minus 500, that is 100. Divide by revenue. 600. What is the gross profit margin? 17%. Okay, that is the year 2023. Then what about the year 2022? Again, take gross profit. That is the difference between 500 and 400. Revenue minus cost of sales. Right? 500 minus 400. Divide that by revenue figure. 500. So yet again, numerator is 100. Divide by 500, 20%. Gross profit margin has come down. Comparing with the last year 20%, it has come down to 17% in the current year. You have not been given the figures for the industry over here, right? You have not been given the numbers. Right, Roman number 1, first computation done. Okay. Then inventory holding period. So how to calculate the inventory holding period? How to calculate that? Your numerator of the equation is what? Your average inventory. So inventory holding period, you take average inventory. Average inventory figure divided by cost of sales. Cost of sales. Multiplied by 365. Then you get inventory holding period. What does this mean? How many days that you hold your inventory before you sell them? Okay. How many days that you keep your inventory before you sell them? Always better to have a lower period. Why? Holding more inventory means what? Having inventory in your warehouse many days means what? There can be obsolete inventory situation. There can be write-offs. unnecessarily your money is tied up in the working capital. So it's better to reduce the inventory holding period. Now, if you do the computation here, what is the average inventory? 200. Cost of sales, 500. Now, looking at the answer, 200 is the average inventory, right? Cost of sales 500, 200 divided by 500 multiplied by 365. How many days? 146 days in year 2023. Then, what about 2022? Average inventory 175 divided by cost of sales 400. 175 divided by 400 into 365. How many days? 160 days. So what has happened to the inventory holding period? It has come down. That's a good sign, right? Because you reduce your working capital tied up in inventory. As I mentioned, having more and more inventory days means what? There can be inventory write-offs. There can be inventory obsolescence situations. So it's a good sign. Your inventory holding period has come down. But you don't need to interpret here, right? So in the exam, don't waste time. Here the examiner is asking you just to calculate. But as an additional thing, I'm doing the interpretation. But that is not required in the exam. Just do the computation, calculation. Right? Then data collection period. So how to calculate the data collection period? Average receivable divided by sales, right? Your revenue. Here we assume that all sales are credit sales multiplied by 365. What would this give you? How many days it will take for you to collect money from your customers? When you make a credit sale to your customers, how long will it take for you to collect those money? Again, what is better? Having a higher period or lower period? Lower period is better. You should collect as soon as possible. Otherwise, there can be bad debt, doubtful debts. And also, your money is unnecessarily tied up in the working capital yet again. So basically, Roman number 2 and Roman number 3 are relating to the what ratios? Working capital related ratios, efficiency ratios. How efficiently you manage your working capital. So the Roman number 1, gross profit margin, is a profitability ratio. Right? So if you do the computation, what is your receivable figure in the year 2023? 60 million. 60 million divided by revenue, how much? 600 into 365. 60 divided by 600, that is average receivable, divided by revenue 600 into 365, 37 days. Last year, that is 2002, average receivable 55, over here 55, then revenue 500, 55 divided by 500 multiplied by 365. How many days? 40 days. So yet again, receivable collection period, debtors collection period has also come down. That's again a good sign. You collect money early from your customers, right? Then you might have a question, okay, why do we take average inventory? Why do we take average receivable? Average means what? Period beginning and period end divided by 2. If it is a year, let's say this particular information revenue is given for a year. In this case, revenue is given for an year. Then year means revenue would occur throughout the period, throughout the 12 months period. So because of that, what you need to do is when you are taking the receivable balance, you take the opening and closing receivable, you add them together and divide by 2. So where you get the average receivable. So sometimes in the examination, now let's say in this particular matter, if you are not given the average receivable and the average inventory, sometimes you might be given the closing inventory and the closing receivable. Then you have to take closing figures, right? But when you have the average figure, always take the average figure, because why? Revenue would occur, cost of sales would occur over the period of time. Then rather than taking the year-end figures, always we will take the average numbers. But in the examination, if only the year-end figures are given, then you need to do the computations based on that. I hope you understood about it. Right. Okay, so the computations are done, and this is the answer. So I have explained to you. That is actually part A. Part A is complete. Right? Part A is complete. Right. Then part B. Part B, we already looked at the gearing, right? I have already commented about the gearing because both debt to equity and asset to equity ratios have come down compared with the last year. That means gearing has been reduced, leverage has been reduced, and company leverage or the gearing is less than the industry. So which indicates that company's financial risk has come down compared with the last year, as well as it is lower than the industry. As the gearing is low, company results a higher interest cover. What do you mean by interest cover? As mentioned, how many times how many times that the company can pay interest by using your operating profit, by using your profit before interest and tax, how many times where you can pay interest. So last year it was only 1.8 times, that is year 2022. 2023 it has gone up to 2.27. That is better. So the ratio is higher means always better. So why it is getting better? Because gearing is getting reduced means interest cover is going up. So this interest cover is significantly higher than the industry average as well because company's gearing is less than the industry. I have already explained that we have gone through the answer as well, right? So the answer is there. We have already gone through. Anyway, the things what I have mentioned is there in this particular slide. You can go through. Right, that is done. Then most important thing is we also need to comment about the return on capital employed. So this is one of the key ratio, one of the important ratio that the ratio analysis question always focus on, right? Understand this concept well. Now now if you look at the ROC, you have been given the ROC. Last year it was return on capital at 26%. That is 2022. It has come down to 22.5% in year 2023. So there's a reduction in the ROC. But still, ROC is greater than the industry average. So one thing you can say that is ROC has come down, but still it's better than the industry, right? Then you have been given certain number for the asset turnover. Last time 1.3 times, this time 1.5. Industry 2. What do you mean by asset turnover? Asset turnover, right? Okay, to understand that, let me write this particular information. So how to get the ROC? How to calculate the ROC? ROC is very important. How do you calculate the ROC figure? ROC, I would say, is equal to, right, your numerator would be, just a different color. Your numerator would be profit before interest and tax divided by capital. That is ROC, and that is the figure what was given in the question as ROC. Right? Profit before interest and tax divided by the capital employed. Capital employed means what? Equity plus long-term interest-bearing debt. Okay, so the capital, that is equity capital plus long-term interest-bearing debt. So that's why we are taking the profit figure without deducting the interest. Profit before interest, because debt is included in the denominator. As debt is included in the denominator, you take the interest to the numerator. Without deducting the interest, what is the profit? Profit before interest and tax. Now, what we can do is this ROCE ratio. I can write the breakdown of this ROCE ratio. So what is the breakdown? I am breaking this into two components. One is, I would say, the one part out of this is profitability. Let's say profitability, how to write it? IT divided by revenue. What is this ratio? PBIT divided by revenue. What is this? What do we call this? Your profit margin, right? I would say operating profit margin. Operating profit margin, right? PBIT divided by revenue. Then I multiply this by revenue divided by capital. What is this ratio? Revenue divided by capital employed. This is asset. So basically, now once you multiply, look at this PBIT divided by revenue from revenue divided by capital employed. What does that mean, revenue divided by capital employed? For each 1 rupee that we have invested in capital, for each 1 rupee that we have invested in the capital, how much of revenue that the company has generated? Having a higher asset turnover ratio is always better. That shows our capital is efficiently utilized. Having a higher asset turnover ratio is always better. For 1 rupee that we invested in capital, you are earning more revenue, means what? It's a good thing. Now, when you multiply PBIT divided by revenue into revenue divided by capital employed, when you cut down these two figures, revenue to revenue would be offset now. Then what is remaining? PBIT divided by the capital employed. That's why we say that our ROCE ratio is a multiplication of your operating profit margin into asset turnover. So if someone asks you how to increase the ROCE, what is your answer? What is your simple and direct answer? You can do two things to improve ROCE. Either you improve your operating profit margin, or else you improve your asset turnover. These are two things that you need to do to improve your ROCE. Now, when you know this, you can easily answer this question. If you know this relationship, now you can easily answer to the question with the logical manner. With the logic, you can answer. How do you answer? What do you say first? Now, in this question, right, in this question, you have been given the capital employed. Right, current year, that is 2023, last year 2022, as well as the industry average you have been given. Then asset turnover is also given 1.5 times, 1.3 times, and 2 times. What is the missing figure here? Now you can say, tell me, what is the missing figure? If I were you, what I'm going to do is, I do a computation by myself and put this. What is that? I calculate my operating profit margin. How do I calculate the operating profit margin? Because I know operating profit margin into asset turnover is my ROCE. Operating profit margin into asset turnover is my ROCE. Now, what you need to calculate? You have been given the ROCE figure and you have been given the asset turnover figure. What you can calculate? Easily you can calculate the difference between these two operating profit margin. Difference means what you will do is you take the return on capital employed 12.5% divided by 1.5. What is the answer that you get? 22.5% divided by 1.5. How much? 15% is your operating profit margin. Right? On other hand, 15% is your operating profit margin multiplied by the asset turnover 1.5 times, you get your return on capital employed. That's what we learned. Right? If I apply year 2023 numbers for this, your operating profit margin is 15%. You multiply by your asset turnover 1.5 times. So what is your ROCE? 22 point. This is year 2020. Correct? And then you have to answer, right? What is my operating profit margin in year 2022? How do we get it? What is my operating profit margin? Tell me. 26% is the ROCE. Asset turnover is 1.3 times. 26% divided by 1.3. How much? Operating profit margin is 4%. Right? Right. So tell me in industry, what is my operating profit margin? ROCE is 18%, asset turnover is 2 times. So how do I get the operating profit margin? 18% divided by 2. How much? 9%. When you have this, now your job is very simple. You have all the figures now to do the commentary or the analysis. What you can say? So you ask about analyze the company's performance in year 2023 against the industry and against the prior year in relation to ROCE. So you say first of all, comparing with the last year ROCE figure of 26%, this year it has come down, 22.5% it has come down. But still it is better than the industry. Last year to this year it has come down, but I am better than the others in the industry in ROCE. Right? Then you can say that by looking at the components of ROCE, by looking at the what? Components of ROCE, asset turnover, that is the efficiency of utilizing your assets, has gone up. You see, even though comparing with the last year, your ROCE has come down, your asset turnover has what? Gone up. Efficiency of utilizing the asset has gone up. But that is below the industry. Okay, asset turnover has gone up, but that is below the industry. So what is the problem that the company has faced comparing with the last year? The problem is with the operating profit margin. No? Operating profit margin last year it was 20%. It has come down to 15%. Okay, significant drop. So because of that, even though the asset turnover has gone up slightly, your ROCE has come down. But even your operating profit margin has come down, that's true, up to 15%, but you are far better than the industry. Because industry operating profit margin is what? 9%. So in your company, even though in 2023 it has come down, still it is 15%. Right? So that's why you are maintaining a higher ROCE comparing with the industry, even though your asset turnover is less. The asset turnover is less compared with the industry. If you are the finance manager of the company, what are you going to do here? Based on this available information, what is your job? What is your advice to the board of directors? So this is what is expected from a CFO. So you become a CFO in the future. I want you to advise. Here, yes, our asset turnover has gone up in the current year, but we are still lagging behind the industry. If we increase our asset turnover, then what will happen is we can increase our, if you achieve the industry asset turnover, let's assume you achieve the industry asset turnover two times, then what would be your ROCE? 30%. Okay, while now directors might be worried about profitability has come down 20 to 15%. Yes, that's true. But you are better than the industry. So, but you are worse than the industry in terms of the asset turnover. So these are things that you need to highlight in the community. I have actually explained you more than enough. So you need to write this much. So what it says, companies ROCE has decreased to 22.5% from 26% in last financial year. That is financial year 2022. This is still better than the industry. Better than the industry. However, asset turnover is 1.5 times in year 2023, slight increase from year 2022 number. But this is below the industry average. Right? Companies less levered and has lower asset turnover compared to the industry that we know. Companies asset turnover is less. However, ROCE being higher than the industry suggests that its profit margin is significantly better than the industry. So this is the very important point. Even though companies' asset turnover is less than the industry, right? Asset turnover is less than the industry. Look at the numbers, you see, asset turnover is what? Less than the industry. But still, companies making higher ROC compared with industry because my company's operating profit margin is very good. Right? Companies managing the P&L very good. So there may be a lot of cost cutting, cost savings initiatives have been taken comparing with the industry. So that's why margins are better. Okay, so the profitability wise, companies doing well compared with the industry, but not in terms of the what? Asset. Right. Okay, so with that actually we are done with that particular question as well. So question number 5 is also completed. Now we have now completed actually the first 5 questions. First 5 questions means first 2 sections of your exam paper is done. Section 1 and section 2 is done. But we can do section 3, right? So in section 3 also you have 2 questions. Question number 6 is from consolidation. The question number 7 is from standard question, right? Question number 7 is accounting standard related question. What we can do is we don't have time to the consolidation question. We can start question number 7, right? We can start the question number 7. We might not have time. We might not have time to complete the entire thing, but we can discuss part of it, and the remaining part we can discuss at the next session, right? So I'm going to I'll tell you when the next session will be conducted. So what we can do is, so we'll discuss consolidation related question and the remaining parts of the question 7 in the next session, right? So what is the question number 7? So if you look at there are 3 parts of this particular question number 7. So the part A is prepare the related party transaction note to be disclosed in the financial statements of Happy Eat for the year ended 31st March 2023 based on the information given in Roman number 1. Right. So basically part A only 4 marks. So that is about, based on the information what is given in Roman number 1 above, you have to prepare the related party transaction note in the financial statements of Happy Eat for the year ended 31st March 2023. Right. Look at Roman number 1. So let's start reading the question from the beginning and then look at Roman number 1 and whether we can see whether we can answer that question. So a simple question, 4 marks. Jumu PLC is the parent company of Happy Eat Limited, that is called as Happy Eat, and Danny Private Limited. Okay, so there are 3 companies here, right? I would say I'll write here. So the first company is what? Unique PLC. We'll call that as unique. So unique. Right, then you have Happy Eat. Okay. And you have Dan. So Yummo is the parent company of Happy Eat and Dan. Right? What is the business of Yummo? Yummo operates in the food franchise industry. So Yummo is into food franchise industry. Happy Eat operates restaurants. Then Danny does the catering. Right? So the parent company is in food franchise industry. Happy Eat, one of the subsidiaries of the parent company, and the question is tested from that particular company's point of view. That is very important to understand. You have to prepare the related party not to be disclosed the financial statements of what company. Happy Eat. Right? This is why it is important to read the question properly. For the year ended 31st March 2023. That you should not answer the question from parents' point of view. It is from the perspective of Happy Eat. Reporting entity in this situation is Happy Eat. Okay. Right. So then Happy Eat constructed its Panadura building. So the Happy Eat means our reporting entity in this scenario constructed its Panadura building as a building or land owned by Yum. Now this particular company, Happy Eat, which is the reporting entity in this scenario, constructed a building. And that building was constructed on a land belonging to the parent company. Obviously, there should be some kind of a rent payment. Let's see. Then Yum, that is the parent company, Yummy, right? Rented the land for 30 years, I mentioned. So the parent company rented the land for 30 years to the subsidiary. And per agreement, monthly rental is 125,000. Okay, so what has happened is, so the Happy Eat constructed the building. So Happy Eat constructed the building. But the land belongs to parent company, right? So what Happy Eat does is it is taken for a 30 years, under 30 years lease or a rental arrangement. So Happy Eat has to pay what? A rental to Yum. So how much is the amount of the rental? Monthly rental is 125,000. Okay, so that is important information in this question. Okay, then following transactions occurred during the year ended 31st March 2023. So we have been given what are the other transactions. Yummy uses, that means parent company uses the ground floor of the Happy Eat's building. Land belongs to the parent company. Building is constructed by Happy Eat, but the first floor, not the first floor, sorry, ground floor of this building constructed by Happy Eat is used by the parent company. Yummy uses the ground floor of Happy Eat's Panadura building as the admin office at a rent of how much? 50,000 rupees per month. Right? Then his parent company is making a rent payment to Happy Eat per month 50,000 for using the ground floor of the building. In addition to the admin office rent, Yummy reimburses monthly expenditure of 10,000 for Happy Eat. Now, very carefully understand this, right? Parent company is using this building ground floor. For the usage, parent company is paying a monthly rental of how much? 50,000. In addition to that, parent company is making expenses reimbursement 10,000 because when parent company is using the ground floor, the utility cost and all that is borne by the subsidiary Happy. So for those, subsidiary is claiming how much? 10,000 per month. That means per month, first of all, parent company is paying 50,000. On the other hand, another 10,000 as expense reimbursements. So two payments are made by Yummy to Happy Eat on monthly basis. Right? Then pays a parking fee of 15,000 to Happy Eat using the car park. So this Happy Eat's property is having a car park. that car park, what happens? Then that is the other subsidiary of the parent company is paying a parking 15,000 to Happy for the usage of the car park. That is right for. Then Happy Eat recognized a lease interest expense of 619,801 for the year in relation to the return land. Now, I hope you are aware, if you look at this transaction, parent company has a land, it was given to the subsidiary, that is Happy Eat, for a period of 30 years, where the monthly rental is 125,000. What is the standard that is applicable for this particular transaction? What is the standard? Can anyone tell me? SLFRS 60 is applicable because these are what? Obviously, related party transaction span is applicable. What I'm telling is for this rental arrangement, giving the land for 30 years to be used by the subsidiary, and the subsidiary is paying monthly rental. So what subsidiary has to do is, what Happy has to do is, Happy has to recognize a lease liability on this particular arrangement, in this particular land, right? In this particular land, subsidiary has to recognize a what? Lease liability. On the other hand, right of use asset in the books of the subsidiary, because subsidiary will become the lessee. When you have a lease liability, which is a financial liability, right? So lease liability has to be subsequently accounted at amortized cost. When you account the lease liability at amortized cost, what will happen? It results lease interest expenditure. For the year, 619,801 is the interest expenditure. You know what I'm saying? So what it is, the transaction is lease rental payments. Monthly, you pay 125,000. These lease payments, now this is the monthly payment. So if you want to calculate the annual payment, what you need to do? 125,000. 125,000 per month. How much is it? Rupees 1,800,000. 125,000 into 12. That sorry, 1.5 billion. Also 1.5 billion. The total amount of the lease rentals per annum. So out of these lease rentals, how much is the amount of the lease expenditure? So all the lease rental payments, within that you have two components, capital repayment and the interest part. So the interest component is 619,800. Are we clear? Right. So now we know the transactions. We know the relationship between the parties, and also we know the transactions. Now, what is the requirement of the question? The requirement of the question is to prepare the related party transaction note we discussed in the financial statements of Happy Eat for the year ended 31st March 2023, based on the information in the Roman number 1 above. So now we are trying to answer the question. Okay, let me go to the relevant unit. We'll go to the relevant tutorial. Right. This is the relevant tutorial. This particular tutorial I have not yet shared with you. This is the part 2 of the tutorial. First part of the tutorial, that is the answer for the first 5 questions I have already shared with CS Sri Lanka. They would have shared with you. If you not, you can actually get it from CS Sri Lanka. This is the second tutorial which I have not yet shared. I will share that in due course, right? Question number 7. Right, so the first part A is tested from LKS 24 related party disclosures, right? So this related party disclosure standard, or else LKS 24, is applicable for all the entities. It can be a private entity, it can be a public entity, it can be a big quoted company. So for everyone, this is applicable. right? No one can escape. Everyone has to adhere to the disclosure requirements mentioned in LKS 24. In this standard, now, when we need to make a disclosure note, when we need to prepare a disclosure note, normally in the question, examiner is not asking about the disclosure notes, right? So he's asking about the computations, recognition, measurement, but in this time, it's all about a disclosure requirement because this particular standard itself about the disclosures. If you look at the name of the standard, what is the name of the standard? Related party disclosures. There are no recognition or measurement criteria discussed in this standard. It's all about the disclosures. Then what you need to disclose? In the disclosure note, what you need to include? These are the two things. You need to identify and disclose the related party relationships from the perspective of the reporting entity. In this question, from the perspective of our entity. What is our entity here? We have to answer the question from point of view of Happy. From the perspective of Happy, what are the relationships? What are the relationships? There are two companies here, right? Very simple. You have to disclose Yamu or Yummy is my parent company. That's the first disclosure. Then Danny, because there are two related parties to Happy Eat here. One is the parent company, Yummy. And also, Danny, what is the relationship between Happy Eat and Danny? Are they related parties, first of all? Obviously, the parent and the subsidiary are related parties, that you know. That means Happy Eat and Yummy are related parties. Is Happy Eat and Danny related parties? Can I have your answer? Is Happy Eat and Danny are related? Are they related parties to each other? Yes. What is the relationship? Because both these companies are controlled by the common parent. Yummy is the common parent of Happy Eat and Danny. And this Happy Eat and Danny are what fellow subsidiaries under the control of the common parent. These are also called as sister companies. Okay, two companies which are under the control of the common parent, we consider them as sister companies or fellow subsidiaries. They are related parties to each other. So the first thing that you disclose in your financial statement note is one. Happy Eat has two related parties. Yummy is the parent company and Danny is a fellow subsidiary or an affiliate company. Right? You have to disclose that. That's the first disclosure. Then what? So you have to identify the related party relationship. Thereafter, related party transactions and the outstanding balances at the end. What are the transactions that took place during the year? Because you have been given information about these transactions, right? And what are the outstanding receivable and payable balances at the end? So now what we need to do is to disclose this. Right? Let's do that. Let me go to the answer. We have already discussed. Now, remember again, I'm reminding you are disclosing this information from the perspective of which company? From the perspective of Happy Eat. Because the question is about the Happy Eat. Happy Eat is the reporting entity for this question. Because a lot of students do the mistake, they make the disclosure from the point of view of the parent company without reading the question. So the question specifically asked from the perspective of Happy Eat, right? Okay. Right. So what is the disclosure note? First of all, Happy Eat say first related parties, Yummy PLC. What is the relationship? It is my parent. Right? Clear. Then what are the transactions taken place during the year? First of all, Yummy PLC has given their, that is the parent company, given their land to our company, that is Happy Eat. Happy Eat is the reporting entity here. So all this information is disclosed from the perspective of Happy Eat. This is our reporting entity. This is the reporting entry in this scenario. Now, Yummy has given the land for 30 years rent to Happy Eat. And what is the monthly rental? 125,000 into 12. So the rental amount, actually this has to be land rental amount paid, 1.5. That is one transaction. Then I told you from the perspective of the happy eat, so the happy eat would become the what? Lessee of the transaction. There would be a lease liability and there would be a right of use the asset. And according to the question on this lease liability, there's a interest expenditure, which is there, which is disclosed in the question, 619,801. So which you looked at, right? It was mentioned over here. Here, Happy Eat recognize lease interest expenditure of 619,801 for this particular land, because Happy Eat is the lessee. If you have the lessee, you have to recognize the lease liability and the right of use the asset. On the lease liability, you have the lease expenditure, finance cost. On the other hand, right of use the asset, you have to calculate the depreciation. Now, why you have disclosed about the finance expenditure? Because finance expenditure is included within the lease rentals paid by Happy Eat to Yummy. Because I told you a total amount of the lease rentals paid during the year, 1.5 million. Within this 1.5 million, so this 1.5 million consists of two parts, right? So interest component and the principal, right? So the interest component value is given. 619,801. So the total amount paid is 1.5 million. Out of that, 619,801 is for the interest. If requires, you can calculate the principal amount as well. What is the principal amount? If you calculate 1.5 million minus 619,801, that comes to rupees 880,199. So you can do the disclosure better than what is given in the suggested solutions, right? If I were you, what I would do is, I would say the total amount paid to the parent company during the year is 1.5 million. Out of that, finance cost is 619,801. Principal repayment is 880,199. Is that it? Because Happy Eat is the lessee of this transaction, where the parent company has given the land to Happy Eat for 30 years. Right, that is done. Okay, I have explained actually more than what is there in the suggested solutions in the, what is available in the institute website. Then it was mentioned that in the question, parent companies utilizing the ground floor of the building constructed by the subsidiary, and that utilization of the ground floor, parent company is paying monthly rental of 50,000 into 12, how much? 600,000. This would be a rent income to Happy Eat, right? Was mentioned here. Yummy uses the ground floor of Happy Eat, and per month 50,000 is paid. In addition to that, for the other expenditure, subsidiary is getting a reimbursement of 10,000 from the parent company, which means 10,000 into 12, how much? 120,000. So the building is constructed by Happy Eat. Parent is utilizing, that is Yummy is utilizing one floor, ground floor. For that, Yummy is paying a monthly rental of 50,000 per month, and expenditure reimbursement, maybe for the utilities and the other maintenance stuff, another 10,000. So that has to be recorded. That's a related party transaction, right? That's a related party transaction. 50,000 into 12, income 600,000. Then the reimbursement of expenditure, this is 10,000 into 12, how much? 120,000. Are we clear? Now with the parent company, this is with the parent company, you have mentioned the name of the parent company and you explain the relationship. it is the payer. Then you have listed down what are the transactions, nature of the transaction, and the amount of each transaction with the parent company. That is done. So this is done. And all of you are aware, right? Parent and subsidiary are related parties to each other, that you know. That you know. Then the other related party is what? Your fellow subsidiary or the sister company, Danny. You have to mention that it is a subsidiary, another subsidiary of your parent company. That is the easiest. Or else you can say it's a fellow subsidiary. Okay, or else it's an affiliate company. You can use different names, but you know the relationship. Now with Danny, actually only couple of transactions, I would say. Right? It's mentioned over here. With Danny actually, what they do, Danny pay a parking fee of 15,000 to Happy Eat for using the car park. Right? Danny means your fellow subsidiary is paying parking fee. It was not mentioned whether this is for a month or whether this is for a year. Right? So because of that, some students have taken this as monthly fee and others have taken this as annual fee. So because of that, so the marks have been given for both parties, right? Because in the other cases, it's not mentioned 50,000 per month, 10,000 monthly expenditure. Always it was mentioned monthly rental of 125,000. But here, 15,000 parking fee was not mentioned whether it is for a year or whether it is for a month. It was not clear. So because of that, what happened was marks have been given for both. Now you disclose the name of the related party, Danny Private Limited, which is a fellow subsidiary or the subsidiary of your parent company. Transaction is our company, reporting entity is Happy Eat, right? Our company is getting a parking fee income. If 15,000 per month, that would be 15,000 into 12, 180,000, or else if 15,000 is for the entire year, the value is 15,000. Right? So in summary, what you need to disclose in terms of the related part, with regards to the related party transactions, what you need to do is actually you need to identify what are or who are the related parties to the reporting entity. So in this question, there are two related parties, parent company and the fellow subsidiary. Then you have to disclose what is the, so first of all, identification. That is this. First of all, what? Identification, first column. Then you have to disclose what is the relationship between these two parties. So the first one is a parent company, second one is your fellow subsidiary. Then what is the nature of the transaction and the amount of the transaction. And also in this question, you don't have any information about, listen this carefully, in this question, you don't have any information about what? Outstanding balances at the year end. If you have any receivable or payable balances from the related parties at the year end, that has to be disclosed. Not only that, if you have provided any impairment allowances with respect to the related parties, that also has to be disclosed. Right? Then you have to disclose your terms and conditions of the transactions with the related parties. So there are a lot of disclosures to be made, but all these things are not relevant to this particular question. What is relevant to this question, I have explained to you in detail more than what is required, more than even what is available in the suggested solution, which is there in the website. I hope you understood, right? Always you have to ensure that you keep a track on the time, because of this question, even though we spend a lot of time, I spend a lot of time in explaining you the answer. But remember, it is only 4 marks. So the time period what you have is 4 marks into 1.8. 1.8 minutes per mark. So which means just 7.2 minutes within that time period to answer. So that's the challenge. Right? But in this paper, so many easy questions were there, right? The questions that we discussed in terms of the ratios, ethics. So those won't take that much of time for you to answer. So the time that you save there, you might be able to utilize for questions in this nature, right? Okay, so that is actually the answer to part A of the question number 7, right? So the remaining 2 parts, part B and part C, what we can do is we can do that in the next session, as well as most importantly, consolidation question, which involves a joint venture. So in this particular consolidation question, this question number 6, you have a joint venture. So that particular consolidation question, including a subsidiary and the joint venture, plus the remaining parts of the question number 7, we can discuss in the next session, which is scheduled on 9th December. 9th December, that is a Saturday, right? Not coming Saturday, next Saturday. 9th December, we can discuss that. Until that, you have time to try the questions by yourself, because we discussed a lot of questions in this paper. Actually, more than 60% of the paper is discussed. You can go through these areas again, and also you can come with your answers to the consolidation question and the accounting standard related question, that is the last two parts of the question number 7. Because don't do this mistake in the examination. Don't wait up until the examination to write answers by yourself, right? You just have 1 month now itself, write and practice. So that's why even we are giving you some time now before discussing the next couple of questions. You do it by yourself, right? You attempt to these questions by yourself, and even the questions that we discussed, you do it by yourself once again, right? Then only you can manage the time in the exam. Don't do the mistake of writing first time in the examination within the 3 hours time. That's costly. Right. So students, I believe that you got knowledge out of the session today. So as mentioned, so what we can do is we will have the last session on 9. So up until then, study hard, because you just have few days for the examination, and ensure that you get to the examination this time. Okay. Right. So any questions? So any comments? Not, we can make a conclusion to the session today. Right. Good night, everyone.